A new report points to a big pullback in venture capital deal making. Pitchbook data shows the number of deals fell by 40% in the second quarter compared to the previous quarter. And it's down 42% when you compare the first half of the year to the same period last year. Let's dive deeper into the data. We've got Vincent Harrison, Pitchbook Venture Capital Analyst. Vincent, just walk me through the headlines coming out of this report. It's certainly not a surprise when you think VCs are also turning cautious right now on their investments, but the deal counts have kept up.
That's right, yeah. Thank you for having me. So basically, of course, as you mentioned, deal counts have somewhat kept up. But what's happening here essentially is that you're seeing a lot of deals still occurring. And what that's basically pointing to is the fact that there is this impetus to kind of put in extensive capital runway, but to also kind of like avoid dilution. And so a lot of companies are still able to gather funding, but you're not nearly seeing it at the volume or magnitude that we were seeing in 2021 and 2022. And so across all stages of VC, things are trending downwards in deal making. They've continued to trend downwards since the second half of 2022 and will likely remain that way through the end of the year.
When you look at the deal count specifically, to what extent have those been concentrated in artificial intelligence? We've been talking so much about the excitement in this space, but I wonder how you look at that number and then pull out AI and see where we are beyond that.
Yeah, absolutely. Of course, AI has been getting a ton of hype and craze thus far through the year. A lot of that, of course, off the back of the release of ChatGPT, success stories like self-driving cars, personalized recommendations and things like that have drawn a ton of attention to this space. But it's also important to remember that when we're looking at a lot of this data, there are your outliers. Of course, OpenAI, kind of brought up a bunch of deal value. So $22 billion in deal value in Q1 of 2023. Again, over half of that was generative AI technology as well as OpenAI. And so actually, if you extrapolate that out, what you'll see is that AI and investment in AI technologies has kind of followed the broader trend of the venture market, which has been a downward trend. And so again, we'll continue to see how that keeps up through the end of the year, but it is important to remember those outliers.
What do you attribute to even the pullback that we're seeing in AI? I mean, that's a pretty short runway if you consider where we came from in November when ChatGPT was first launched to now. If we're already seeing a bit of a pullback in investments, what does that tell you?
Yeah, I think for a lot of investors, what they're really looking through is for these breakthroughs in technology, these breakthroughs in research. And so AI is nothing new. AI has been around for quite a while. But what you are seeing is this garnering of public interest in AI technologies. And for a lot of savvy investors, what they're really looking for are these breakthroughs, particularly on the generative AI front. And so, again, that's why companies like OpenAI are able to kind of command those large checks. But for a lot of older, mature organizations that are unlikely to have a research breakthrough, they aren't able to kind of command that capital that some of other organizations that are on the impetus of having a research breakthrough are able to.
What has all this meant for startups, particularly the late stage startups who maybe a few years ago would have considered tapping the public markets in a slowdown on the VC side? I mean, what does that exit strategy look like for some of those companies right now?
Yeah, it's tough. I mean, a lot of those organizations were priced in an environment where there was a lot of emphasis put on this growth at all costs. A lot of the multiples were put on that, and a lot of emphasis was put on that. I think right now what you're seeing is this kind of back to basics mentality where instead of looking at growth at all costs, what you're really looking at is path to profitability. How much free cash flow do you have? What does EBITDA look like? Some of those fundamental business metrics I think we're starting to return to. The exit environment, of course, as you know, is one of the worst that we've seen probably since the global financial crisis. Thus far through the year, roughly $12 billion in exit value in the US. If you were to annualize that figure, you come in under $250 million or $250 billion, $25 billion on the year, which again would be the lowest in the past decade by over $50 billion. And so I think what we're going to be looking at is a lot of these organizations are going to take the time to retool their business models and to innovate and really look for a path to profitability as opposed to growth at all costs.
And you talk about the tough environment in the public markets. Traditionally, these companies maybe could have looked at potential acquisition too, but M&A is certainly not positive, at least when you think about the outlook and regulatory scrutiny. Can you talk a bit about how companies are thinking about their strategy moving forward in the face of this regulatory environment?
Yeah, it's definitely tough. Of course, the FTC and the Department of Justice have heavily scrutinized a lot of acquisitions or potential acquisitions, which worries, CEOs who may have saw that as an exit opportunity. Of course, being able to stay private is a privilege, and in order to do that, you do need to raise capital, either dilutive or non-dilutive capital. Right now, the fundraising environment for startups is really tough. It's an investor-friendly market. Investors have a lot of leverage at the table. Valuations are trending downward, and so the prospect of going back into the fundraising market to look for equity financing anyway could be a bit, worrisome. And so I think what we'll likely see is that a lot of these CEOs, if they're unable to exit either publicly or through an acquisition, are going to try to find sources of capital, potentially venture debt, for example, non-dilutive forms of capital, to extend runway until things pick up back in the exit environment.
Yeah, we've heard a lot of startups having to hunker down in this environment. Vincent Harrison with Pitchbook, appreciate the time today.
Thank you for having me.